We start with, hey, welcome to Spin Out, winner Dave, and we kind
I'm
of
winner.
Today, we're here to demystify venture, minimizing FOMO for VCs through the relationship between GPs and LPs.
So it's been a few weeks. So let's start with the big picture here in terms of topics review. So this is the series on operational due diligence. We want all managers out there to really understand what is operational due diligence, and in particular, what you should be doing as a GP with respect to this process, and also understand from the LP perspective, what do they care about? So we've already done a number of episodes in this series, including talking about team, talking about alignment with your LPs, talking about track record, fund formation, legal terms, risk management. I'd recommend going back and reviewing those episodes. But for today's episode, we're going to dive into regulatory compliance. Dave, why don't you set the kind of picture here of what we'll be talking about specifically?
Yeah, so I know compliance and regulations are everyone's favorite topic. They do come from a place of ultimately trying to build a healthy market, right? And if we all are doing what we're supposed to and there's high trust, then deals get done, LPs come into funds, everyone is much happier. And so if we do compliance the right way, and if GPs have just the amount of compliance mindset they need, we can save a lot of time and we can create a lot better relationships with LPs. So I think there's high value here for the amount of work that GPs will have to put in, but it is definitely something that you do have to think about. And when we talk about compliance, we're going to kind of lay it out in a couple of different ways. So first, we're going to talk about who you are as a firm and what types of rules or laws or regulations apply to you and from which different agencies and at which different levels, because it is kind of a chaotic matrix of a lot. We're also going to talk about specifically the difference between an ERA or an exempt reporting advisor and a registered independent advisor. And then as specifically it pertains to ODD, we're going to talk about why LPs care about it. And ultimately in this process, what are they trying to learn and what does it actually feel like to go through ODD, talking about regulation and legal compliance?
Yeah, so I think for this episode, we're largely going to take the perspective of a US fund. So you're a US based GP. The first question you should ask is, what am I? So you operate in a set of US laws, federal, state, local, and you should be thinking about it from the SEC perspective, right? So how is the SEC thinking about you? Like, what are you with respect to the SEC? From the IRS perspective, right? The tax perspective. So, if I set up my business this way, if I set up my fund this way, what are my obligations to the tax authorities? You should be thinking about it from the state perspective. So depending on where you set up or where you raise capital, there will be certain filings that you're responsible for, including blue sky filings, for example. And then also thinking about it from the local business perspectives, because sometimes you can be out of compliance if you reside in a certain state but are registered elsewhere, right? Sometimes there are kind of local registrations that you need to think about, or again, local state specific laws that you're going to have to comply with. So again, I think the first question is, what am I, to kind of, kick this off and figure out, how you should be setting up your fund appropriately and compliantly.
I mean, the number of different agencies that you have to work with in the US and the number of different levels of government, I highly think that what we often see is that the fund counsel is intimately involved in this process. So as you're trying to figure out what you are, definitely consult with your fund counsel. And if you have an accountant in your life or can get to an accounting firm, you should ask these questions about how to set up your management company, your GP, your LP, and what regime you're going to follow for compliance with those types of individuals who can give you specific tailored advice to your situation. That is definitely critical.
And the last one there, you might even want to think about talking to, your tax team, because they might understand, again, specific state or local regulation that might pertain to you, versus other funds that you might be talking to on a peer-to-peer basis. They might be registered elsewhere or based elsewhere. So they might not understand some of those local things that could be beneficial for you, or again, they could be things that you just have to deal with.
For anyone that owns a business or general partners running a venture capital firm, compliance is something that you are ultimately responsible for, and you can delegate authority to do the tasks or to make sure the checks are done. But at the end of the day, as the business owner, you are responsible. So it's definitely highly recommended that you surround yourself with good, competent people to help you that you can delegate to. And then you focus on just making sure overall your firm is operating in a compliant mindset and that you at the top are kind of pushing the right things.
You mentioned that we're going to talk about the difference between an ERA and an RIA. So are we talking about baseball stats here, or are we talking about fund regulation? What's the difference?
Yeah, that's a great question. So there are a lot of acronyms in venture, and we often use acronyms without really always explaining exact what they mean. And so first, we should start with RIA, Registered Independent Advisor. Now, this is one of the key kind of concepts that came out of all the investment company acts and the regulation that has evolved over the last 100+ years in the U.S. That we think of the Registered Independent Advisor as regulated by the Security and Exchange Commission, the SEC, and there are prescribed rules and things you have to follow. And if you want to take money from other individuals and invest it in certain ways, the SEC has a clear set of rules and laws that you must adhere to. Now, to do that often is expensive. You can imagine you'd have to have advisors, legal, and you'd have to have software maybe to help you manage this. It can take time, and you might even have to hire a person to help you become your compliance officer. So the RIA status gives you a lot of flexibility to work with a lot of different types of investments and investors, but it does come with some actual dollar costs and some time costs. So the SEC created an alternative called the Exempt Reporting Advisor, the ERA, that specifically pertains to venture capital funds that operate in a certain way. And so the ERA exception allows you to not have to fully register. And that's key because as a brand new emerging fund, you want to act in a compliant way, but you may not have the budget to hire all these advisors and lawyers and folks to help you. And so by putting out a certain set of requirements and restrictions for ERAs, the SEC has created an environment where brand new venture capital funds can get into business, can follow the important rules, and as long as they stick to those rules, then they don't have to do all the extra work that is required for RIAs. So that's a very key distinction, and one that all fund managers need to think about as they're thinking about who they're going to raise money from and what types of investments they're going to make.
When do you see that switch happen? So a lot of the funds that we work with typically fall under kind of this ERA exemption. What and when do you see the funds switch from ERA to RIA?
There's two kind of pathways I think are the most obvious. One is when your AUM hits a certain threshold that the SEC has set, and there's some other conditions as well in that. But once you hit a certain threshold of AUM and you're investing in a certain way or with certain LPs, the SEC then says you must now be, complex enough and have enough budget to enter into this compliance regime that we expect. So one, it can be an AUM test, and your attorney can help figure out if that's exactly what matters to you. The other is, and the one more common, when you want to invest in non-qualifying venture capital investments. So the exemption specifically kind of carves out, for lack of a better, if you buy stock or invest directly into the cap table of an underlying portfolio company, that will be covered by the exemption. However, if you want to do things like SPVs or fund of funds or crypto, those are non-qualifying venture capital investments, and there's a threshold. So if you wanted to do those types of investments and you didn't want to meet that threshold, that could cause you to have to register as an independent advisor. And without getting into all the details there, but basically it would be a choice that the GP would make to expand their investing universe outside of just your traditional venture capital investments.
So thinking about it from the ERA versus RIA perspective, depending on, how you're going to do your early registration, what are the disclosures here, right? Like what should I be thinking about as a GP? And, how should I be thinking about kind of the cadence of filings? Like what is the burden here for me as the GP?
The way I kind of have experienced it myself is the first parts of compliance you meet with is even before you're probably fully formed as a venture capital fund. It's when you're out fundraising, right? And even though you may not be a fully closed investing venture capital fund, you still are required to comply to the Investment Company Act and the Investment Management Act and other SEC regulations, which require you to disclose to LPs the material and relevant information. So if you're going to go out and start fundraising, definitely go ahead and contact a fund attorney to see, one, do you need to start adding disclosures to your marketing materials as you're engaging with LPs, and to make sure that you're engaging with potential LPs in the right way so that you don't inadvertently kind of pigeonhole yourself into a certain type of registration. Definitely go talk to that fund attorney to figure out where you should start. As you move forward, you will need to engage with, outside of the traditional like small business kind of compliance, state of Delaware, your local state, those kinds of things, the IRS to get your EIN. One big thing that you'll have to do that's different than maybe some of your other entrepreneur friends is engage with FINRA. So FINRA is a public-private entity that partnered with the SEC It's the Financial Industry Regulatory Authority. They actually do a lot of the infrastructure to support compliance and with the SEC. So you're going to have to create an account there, get logged in. This is where things like your Form ADV are located, where eventually you'll be able to look up the different filings that your attorneys or you will do. So this is like a central repository. Got to get that set up, as well as another service called Edgar. So again, go to your attorney, get those things set up, make sure you as a GP can log into them and understand generally how they work. And then the other time you need to think about this stuff is when events happen in your firm, right? So you have a closing, you raise an SPV, you have annual change in time. There's different things you have to do for those different events. Your fund attorney will be the one to help you, whether or not you need to fill out a Form D in this time period right after a close, or an amendment to your Form ADV, or just the annual update to your Form ADV or the initial. Like, those are all things that you will need to engage with as part of this process, and you should lean on your law firm to help you go through that.
What I see sometimes from the emerging manager perspective is that because VC, and this is my opinion, has a lower regulatory burden, especially if you're an ERA, than other asset classes, a lot of emerging managers forget they're operating in this highly regulated area. And I think that's important. And it's important because, you know, how Dave started the conversation, which was LPs care about this from a trust perspective, right? So they care about the fact that you care about your compliance requirements. And that's a super important piece here. You know, that's the mindset of compliance, right? There's the mindset of it and understanding like, this is important for my LPs. This is important for me becoming institutional now and, you know, more institutional over time. And this is important for me to care about, right? So that it gets done and I manage this compliance on an annual basis. That really is kind of the system of trust that we're encouraging you to create.
I mean, Winner, would you say, and to some degree, thinking that a large family office or a university endowment or something like that, they have a multi-asset class portfolio. They are engaging with private fund managers in many different asset classes. A lot of them might actually be registered independent advisors and are operating in a way. So could you think, or would you say that there might even be a kind of set of market expectations for compliance, that if you're going towards these institutional advisors or investors, you have to operate in the world that they're already operating in. They don't have to come down and operate in your world.
Absolutely. Yeah. I think that's another perspective that's very valuable, right? Most people, they are going to be pitching, you know, if they're larger check writers, have a multi-asset class portfolio, and they're used to, you know, lots of reporting and lots of compliance. And if you don't meet that bar, like especially that, you know, minimum standard that they have, that's going to be an issue. So that's really something we're talking about here. Switching gears a little bit, right, from the practical side. So thinking about, you know, I'm an LP and I'm performing kind of this regulatory check during the operational due diligence ODD process. What am I actually doing, right? Like, what am I actually asking? There's going to be certain forms, right, that are different than the regulatory filings and regulatory forms, like that are going to come from LPs asking you these questions to make sure you've done the proper registration, you're making the proper filings, you have the policy set up to continue, you know, making those filings on time. Because what they don't want is an out of compliance GP, right? That can create headache for them. They need the information, they need the confidence in you that you're doing the right things, but they also need that information. They need that reporting that's different than performance reporting, right? It's reporting on kind of your business, the operations, the operational due diligence piece. They need the reporting of your operations and how you're handling this compliance so that it's just the checkbox for them.
I think there's some, you know, real rubber meets the road kind of moments for GPs. You know, imagine if you're audited each year, your auditor in some ways is going to bump up against some of this compliance stuff. They will be checking it in their own checks as an auditor of you. And so there are times when your LPs will, not just at ODD, but will throughout the life of your firm, have some form of view into your compliance regime. And your audit is a great point of, do you follow the policies that you set up, right? You might also have experiences where your LPs and their family offices or their institutional teams will just Google search you. So much of these filings and so much of this information is public. And in fact, actually, one of the things you register with is Edgar, which is the SEC's public disclosure database. So they can look this data up on you and can come back to you. And it is awkward sometimes when you get an email from one of your LPs saying like, hey, I noticed your business registration is expired. right? Like that's not something you want your LP to tell you, but they do check and they will send you those emails from time to time.
So we're not going to dive into it in today's episode, but another thing to think about from the LP perspective, doing operational due diligence on your fund is they're going to want to understand and maybe even see and review your policies, including manuals, right? And there's certain policies that are required by law. And they're also going to want to understand your business procedures, right? How you're actually like managing this stuff. Could be included in a policy or it could be separate. Again, those are two really important perspectives that an LP, if you can make it easy for them to understand what are your policies so that they're compliant by law, and what are your procedures so that they're, clear and transparent and repeatable so that you can maintain compliance over time. Those are two things that'll really give you an edge and an advantage as an emerging GP.
Something to your point, Winner, I love your take on this. Often what I see with emerging managers is they're building over time to that RIA status of tools and systems. And so what that kind of looks like is early on, you have some policy letters. It's really important if you create a policy letter, you actually follow it. So there's usually things like valuation policy, AML, KYC, privacy or written information security, making sure you don't let your information go wild. And then like business continuity. There are some that are pretty common that we see. And then a compliance manual. Sometimes you see a compliance manual in an exempt reporting firm. Sometimes it may not be built until they're going for registration. So as an investor in funds and as someone who advises a lot of funds, how do you see GPs navigating this movement from starting with some policies, getting a manual? I'm a small team. Do I have to do all of this extra work? Like how does it play out in your world?
It starts with the mindset, as we discussed. I think the mindset helps create that rigor that is more of like a business procedure, right? It's like if you believe that something's important, right? Like that you believe that you should be compliant within whatever, regulatory framework you're operating in. That's really the important first step. And then, you're building those processes and those procedures. I see the policies as a later step, and it's typically catalyzed by a conversation with a larger check writer. That could be an anchor, that could be an institutional LP, that could be someone who, for the first time is giving you a due diligence questionnaire and asking you these tougher questions on your operations. I think that's when I first start to see from most, funds that are sub 150 million in AUM, when I start to see like that behavior changing, where you actually start to create these policy letters and you start to potentially hire a compliance firm, an external third-party compliance firm, or when you start to, work with that institutional LP to draft these documents and you start to think about operationalizing the policies that you now have to be compliant with.
As someone who has built their own version of the due diligence questionnaire, you thought about the questions that go into a section on compliance. You've asked them yourselves. What are some of the questions that are really important to you when you're going through this to understand that mindset from the GP that they're focused on it, or that they've built these tools? Like, how do you assess that in this process? But what kind of things do you ask for?
Again, I think it's the simple questions and it's the simple disclosures. So that is, where is your business set up? How is it set up? How are you filing to set up your business? Like, have you actually created those? Are those official documents, right? Like, LPs want those simple disclosures. So that's easy, but then it could get a bit more, right? Like, as we mentioned, like, please disclose your insider trading policy. Please disclose your valuation policy. That requires an additional step beyond just like setting up your fund and going out to fundraise. Like now you're actually setting up the operations. You're starting to operationalize, what I refer to as institutionalize your business. And so as an LP, those are going to be questions in your DDQ. And then again, depending on how you're registered, ERA versus RAA, how institutional the LP is, you might get almost like a third set of questions, which are more complex and asking you for, again, additional policies, additional manuals, additional understanding of your procedures and how you're hiring and managing people, and how you're kind of like, properly staying compliant over the course of any given year. So I think there's different levels of questions, right? If you're going to get a DDQ, that's already like a jump to a very institutional conversation. I'd say for most emerging managers, like they're not well versed with a due diligence questionnaire until they run into an institutional LP. But again, like if you want to jump to the next level, if you want to become institutional, you should, engage and in that mindset, that compliance mindset. And that is the first step to answering the questions there's hundreds of questions in the due diligence questionnaire, to like be able to answer those questions knowledgeably, and not only knowledgeably, but answer them so that they're easy to answer because you've already built the process.
And I think that last point's really key. I always, in the circles, CFO and COO venture capital circles, people often are frustrated by ODD processes, but I think of them as practice. I mean, it's practice for game day, especially in your first fund or you're emerging. There are less requirements. You can use the DDQ as a self-assessment and figure out where you're strong, where you're weak, how much effort you actually have to put into getting to the next level. And then you can prioritize that along with all the other priorities that you have. And I think it's a good process to go to because I've done DDQs for a number of firms. Never have I gone through a DDQ and have a perfect, exactly what I think the LP would want answer. And so my next question to you, Winter, is what happens if you're going through one of these processes and the LP asks you a question and either you don't know, you don't have a process, you haven't done it yet. Like, what do you do in that situation?
You make sure Dave's in the room with you. You make sure, say, I'll be right back. I'm just going to phone a friend, and you bring Dave to the conversation. I mean, in all seriousness, like if you can't answer certain questions in the DDQ, like you're at a vast disadvantage in the fundraising process with institutional LPs. So it's the same way as like, if you don't know all the rules of the game that you're playing, then you're at a disadvantage, right? Because maybe some of those rules can actually help you win or help you be better, right? That's the whole point here. I think if you get asked that question, right, like don't panic. If you're early enough on in your fund building journey, then I think some institutions, right, will handhold you through this process. Like they're there, if the performance is there, they're there to assist, right? They understand like you're not going to be an institutional firm from day one, that it's going to take an iterative process. So yeah, I wouldn't panic. I'd really try to understand the question. If you don't understand some of the questions in the DDQ, come through the Coolwater program. Like we build out a DDQ for you during the program. So I think there's this element of like really understanding the sections. Go back, listen to our podcasts, right? We're doing a whole series right now on the different sections of a DDQ, right? And so starting big picture, understand what the big sections are that LPs are going to care about. And then understanding, like if you understand the big sections, understanding the underlying questions that are important under those sections. And if there is a question that you haven't come across, and sometimes questions get added, right? Like I sat on ILPA's research and benchmarking committee, which wrote the DDQ for the private equity industry. So like the way to think about that is that was a living document, meaning like a DDQ wasn't written 50 years ago in venture and it's never changed. Like depending on regulatory changes or depending on other changes, questions may be added. So you might get hit with a question that's never been asked before. That has happened, right? Even over the last few years. And so again, just go in with an open mind, know your business well, go in with that compliance mindset, which I think is also like, hey, if I don't have it, I actually want to have it because it should be there for a reason. Like you're asking for it not to burden me with process, but you're asking for it because it, helps me build and run a better business.
Yeah. And to your point about the uncertainty of what the future will look like, everyone right now is talking about building an AI, using AI inside their firms. And that should probably and will be a more important part of DDQs going forward. How are you locking down the data? Who's responsible for that? I know in healthcare and in the government that do have data required, there are HIPAA compliant AI tools and those kinds of things. And GPs would be wise to always have a compliance first mindset when they're trying some of these new tools, like just to make sure that you don't end up doing something you'll regret later. So yeah, definitely keep an open mind as his compliance will change as the technology and tools change for sure.
I agree. And I think we should switch over to Did You See for the week? So AngelList came out with a 2026 report. Happy New Year, everyone. A guide to fund migrations. So this is a comprehensive guide to evaluate whether you as a GP should migrate your fund to another fund administrator. Dave, you want to touch on a couple of key takeaways here and why would you do this as a GP? And, is this something that GP should be evaluating? And if so, when is the right time?
Yeah, absolutely. So one of the things we do at Signal Fund Services is help people go through the vendor selection process. And there are core vendors that you don't really want to change out. One, because they impact your LPs, they impact your business operations. And so you want to be very mindful when you pick a fund administrator that it's the right one for you. But the reality is businesses change, technology changes, and there may be a different set of vendors in your next fund cycle that are better or different. And so fund migrations happen. I would say the keys to remember are don't forget your LP experience. I think people think very quickly about their own GP experience and the mistakes that their fund admin makes and they want to move, but changing that will impact your capital calls, the wired instructions for LPs, their systems for acknowledging and making sure these are accurate, capital calls and all that kind of stuff. So there will be impacts beyond what you just see. The second part is it probably going to be a little expensive because the best way to do this is to have a little bit of overlap between the fund admins. And so that you might end up be paying for 2 fund admins at once, but this allows you to have some business flexibility. And, if you ended up making a bad choice, you're not, just completely stuck, right? So you want to give yourself a little flexibility there in this incredibly complex process. And then I would say lastly, if you're thinking about when to do this, one, you don't want to do it right in the middle of your audit. That would probably be the absolute worst time. You don't want to do it right before your audit because your fund admin probably will help with your audit process. So usually what I see is typically the best time to do something like this is after your audit's done, the summer comes around or whatever that is for your relative firm, but the slower time comes around and you lead into this, you plan for it for months, you get your documents together, and then you do this transition in like Q2, Q3. And you tell everybody you're doing it at your annual meeting, you lay it out and you're very transparent, but these are very difficult things to do and to do well. And so you want to be very thoughtful about what is the threshold for switching and then how you're going to go about it and what the impact will be to your business and your LPs really.
Great. Well, thanks everyone again for tuning in to another episode of Spin Out.
All right. We'll see you out there.